Hello class, this video will cover material from Chapter 4 in your financial accounting course. The first part of the chapter discusses internal controls. So we'll look at a broad definition of internal controls and go over a few slides regarding how internal controls are implemented. So first of all, internal controls can be defined as anything a company uses to safeguard their assets. Internal controls do not mean that a company's records are perfect, just like a trial balance. Balancing would not mean that it's error-free, but internal controls help to create better accuracy and improve the company's financial records. It's there for two elements, prevention and detection. Just like your doctor visits or your dental visits are there to take care of preventative care, when you're at your appointment, sometimes they detect issues. So internal controls are there as a way to create better financial health, to prevent issues from coming up, and also to detect errors that happened. Some of the internal controls we use are broadly defined as separation of duties. You've experienced these at a job where you ran a cash register and then somebody else counted out your drawer at the end. Somebody else has the duties to print the accounting records and make sure the computer system matches the actual cash you have in your drawer. So internal controls encompass a lot of things that a business might do to prevent errors again and to detect them, also to prevent fraud and to detect it. One of the major pieces of internal controls is to make sure a company performs a bank reconciliation each month. The bank reconciliation is primarily looking at your bank statement and your accounting for your cash account and making those two balance, making those two items have the same total without doing any journal entries initially. We just state the differences. I like to think of it as the game where there are two pictures and you find the differences, find the hidden differences. So looking at your accounting records and your homework problems, you'll often be given the company balance and then also given the bank balance or a copy of the bank statement, and you need to get those totals of the company balance and the bank balance to be the same by adding or subtracting any differences, just like in that game where you would add maybe something that is missing out of one picture to the other picture, or take something away that wasn't included in one of the pictures. So for the rest of the video, I plan to cover an example from your homework. This will be the very last problem on your Chapter 4 regular homework. I believe it is in reference to company Diaz, and it probably questioned 12 and 13. Okay, so every bank rec is done at the end of the month. It looks like on this problem it is May 31st. So we have a point in time where we are pulling the cash balance and the bank balance. You can find the company balance on this problem right at the top under the Diaz Entertainment record where it says cash balance May 31st, 2018, 5,460, and I've written that on the whiteboard. And then you can find the bank balance if you scroll down again in the top kind of right middle section above where it says daily balance. It's going to say $6,632, and I've written that on the whiteboard. So that's really your starting point, is to make sure you plug in the correct numbers for which amount is the company balance and which amount is the bank balance. Then once you have those listed, you will look for any deposits and checks that are outstanding. Those items come from the list on your company account, their record, and then looking down at the bank statement and to see if any of them are not showing up. So usually the last one in the month doesn't show up as posted. It hasn't cleared the bank yet. So that is going to be listed. Always outstanding deposits are added to the bank balance because you already have it in the company record. It looks like on this example, 5/31, there was a $3,000 deposit that does not show up on the bank yet. It will probably show up on June 1st. Also, I looked through my checks in the middle here, and checks 469 and 470 were written back in April, and they're now clearing in May. That is okay. Those are not reconciling items for us. We don't have to list them on the reconciliation. But checks 475 and 476, if you scroll up to the top, those were written in May, and they've come out of my account for the company, how I listed it on my accounting records, but they have not cleared the bank yet. So you'll see on the whiteboard, I have listed outstanding checks for $3,790. That is the combination of those two outstanding checks added together. That's always a subtraction item. I will always subtract those items. And then you'll see there are some things listed on the bank statement. Again, we got to make the two pictures match. I see a few items down on the bank statement that are not listed on the company. So if I go down to the deposits column, you'll see some things noted. The interest is INT and the NOTE is a note we have collected. So I would actually add that. These are things that are already included in the bank balance. I would actually add that note to the company. So that's going to be something we will have to make a journal entry for. So a note received for $1,000. I also have interest received. The bank deposits the interest automatically, so that would be a revenue to us. We've earned it. I'm going to add that to the company balance. It looks like on this example it's $52. Then I'm going to look in the middle, and in this section in the middle it talks about withdrawals and debits. Withdrawals from this account, since it's a liability to the company, anytime we take our money out of the bank, it's a liability to the bank. Our cash is an asset to us, but our cash is being held by the bank. So you are really looking at the bank's statement there of what they owe you. So liabilities, the bank's amount they owe you, liabilities go up with credits when we made deposits, and they go down with debits when we withdraw our money. So in that section where it says withdrawals and debits, that's the liability of the bank, not the company's liabilities. I see checks listed and I see an NSF. Now the NSF is where a client or a customer has written us a bad check. So we're going to have to adjust that. It says the bank took the money back from us, so we're going to have to adjust that on the company balance. We're going to subtract that NSF amount from the company balance. I also see an SF for a service fee. Those are always subtracted. When the bank assesses service fees, those are always subtracted from the company balance. Now in this instance, there is a bank error. It says at the bottom that the bank accidentally charged us, so we need to contact the bank and ask them to put that back into our account. So that would go on the bank side. We would add that amount back to the bank where they made the EFT error. So when I look at those items and I add them up, then I'm going to see if I have reconciled everything I need to reconcile. My journal entries would include a debit to cash for $1,054 is all the increases on that reconciliation, and a credit for the note received of $1,000 and a credit of interest revenue for $54. My decreases to cash include one expense of $32 and one NSF check that needed to be noted as accounts receivable with a total credit of $252 to cash. Those are the two decreases to cash.